Good morning, everyone. Thank you so much for joining us here at the SALT conference today. We have a pretty all-star panel lined up for you. The topic of this discussion is the future of digital assets in a post-spot Bitcoin ETF world. And we have the pleasure of being joined by Cruz, Robbie Mitchnick, Lauren Abendschein, John Wu, and Steve Kurz. Why don't we start today? I would like each of the panelists to provide a quick intro of who they are, where they work, but most importantly, let us know what you were doing before you came to the digital assets industry. So Zoe, why don't we start with you?
Okay, hello. This is a very challenging venue. I've been told to scream. I don't have a problem screaming, so hopefully you can hear me. I am the CEO of Menai Financial Group, a asset management company investing in digital assets. Prior to being involved in this incredible Cambrian explosion of activity, as I say, I was running a fixed income FX and commodity at Morgan Stanley and ultimately running the firm. So for someone that had a front seat at the world globalizing, there was a revolution when I got out of business school, which is finance was going to go global, and being lucky is a wonderful thing. When I joined the firm, it was 1,700 people, a private investment banking boutique. When I left, it was 60,000 people, had offices everywhere. I think this digital asset space is as big, if not a bigger revolution than the one at Morgan Stanley. So I'm very excited to be here.
I'm Robbie Mitchnick. I'm the head of digital assets at BlackRock. I've been at BlackRock since 2018, in effect in that role. And prior there too, I started my career at CPP Investment Board doing public markets and private credit investments, and then had one short, fateful internship at Ripple, where Zoe was on the board in 2017 that ultimately led me to this space.
Hi, everyone. I'm Lauren Abendschein. I'm the global head of institutional sales at Coinbase. I joined Coinbase in 2018, similar to you, Robbie, and have been there for the last 6 years. When I joined Coinbase, we had only 4 assets on exchange, and we're just launching institutional custody. Today, we are the largest institutional crypto custodian, but we host in our institutional business a wide variety of businesses, including multi-venue trading, custodial staking, Web3 wallet, as well as now our perpetuals exchange, our spot exchange, and our CFTC-regulated futures as well. And so have seen quite a change both in the span of institutional offerings at Coinbase, but in response, the shifting and increasing demand from a wide variety of institutional stakeholders. Before I was at Coinbase, I was at Credit Suisse on the prime brokerage team looking after hedge fund coverage for the West Coast.
Hi, good morning. I'm John Wu, president of Ava Labs, the software services team responsible for Avalanche. And but before I was an operator, I was actually, like most people in this room, I was on the principal investing side, a tech investor at funds like Tiger, Kingdom Capital, and ultimately running my own firm. What got me into this space, which is the excitement that perhaps the blockchain could actually rewire the financial services industries and create more efficiencies that I saw needed to be done. And frankly, I'm super thrilled to be on this panel because I remember as a young investment professional at Tiger, I would read about Zoe in the Wall Street Journal and how what a trailblazer she was. And Tiger obviously had a great relationship with Morgan Stanley back in the day. So I'm thrilled to be here.
Hi, my name is Steve Kurz. I'm a founding partner of Galaxy Digital. I run our asset management business, which is an $8 billion diversified asset management platform focused on digital assets. I also remember Zoe in the Wall Street Journal. I was at a firm called Lehman Brothers, which started my career. Should have gone to Morgan Stanley, but have spent 12 years on the traditional asset management side, post Lehman Brothers, building asset management businesses all around the world. A little stint in virtual reality, and then for the last 7 years have been helping build Galaxy from the bottom up. I think, when we talk about the most exciting part of crypto, you could give a million answers. For me, as much as it seems like it's fits and starts, we're in the conversation right now. The courts are figuring things out that Congress people can't figure out. We're going to the president's desk with a bipartisan bill to correct some actions by the SEC, and we're really front and center in this election cycle. And if you had asked me that in 2017, this is the final boss, if you use a video game analogy, and that's really exciting. Hopefully we can make some progress from here.
Great. Well, Steve, why don't we start with you? I want to go a little bit deeper into this institutional interest topic. And I think you started to kind of allude to it with your points on the political progress that the industry has made. But can you go into a little bit more detail about how the digital assets industry has become more mature and institutionalized over the past few years?
Yeah, I guess it's like what progress is and what progress isn't. Progress isn't, when you're dealing with a technology that touches money, that touches big tech, that touches societal norms, affects the big banks, you're not going to have this cool ocean breeze that carries you to the promised land. That's not what progress is. Progress is messy. And crypto is very messy, and our progress curve has been very messy. So it's really hard to see in a moment in time, oh, we're making great progress, because there's a win and there's a loss and there's a lot underneath the hood. I think if you just look at what we're doing in our asset management business today versus 5 years ago, that's progress, right? We are unwinding the FTX estate as court-appointed bankruptcy advisors. That's different. We didn't have a space that could work through bankruptcy processes. I know that it was a bad thing that happened, but the cleanup is important. Launching ETF with Invesco. Obviously, there's other participants in that ETF on stage. That's real. Launching ETPs in Europe. That's real. Venture investments in the rails, right? If one thing has come out of the last 2 years, is that the financial rails on which Bitcoin, Ethereum, tokenization, stablecoins all sit, those are real and those are scalable, and that's a huge TAM. So those things that we're spending our time on, and I know everyone on this panel feels the same way in their businesses, are so dramatically different than the things that we were working on a few years ago. That in and of itself reflects the progress, and it's incremental and it's hard work. And so what we need to do is we need to execute, and we need to grow up, and we're doing that as an industry, and we're not there yet, but we're getting there.
Great. John, why don't we go to you next? You mentioned Ava Labs have seen demand from institutional players. Can you elaborate on the types of institutions that are showing interest and what they find unique about the Avalanche blockchain?
Well, I think what's really great about this cycle, we're seeing a lot of, basically AAA type of traditional financial services firms having demand to deploy real world assets on a blockchain with the help of Ava Labs. We're talking about players on this stage here, JP Morgan, Citi, and Wellington, T. Rowe, and the list goes on and on, Apollo. So I think what's interesting here is there's definitely demand for the technology. What they see in Ava Labs and Avalanche is, I think, a couple of things. One is the consensus protocol Avalanche allows for instant finality, so therefore settlement times can be very low. Secondly, they can customize their own manageable self-sovereign blockchain for their needs based on the assets that they require. And the Ava Labs team has worked really well creating the infrastructure on the permissionless blockchain with partners that have either custodian, a qualified custodian, or MTL license or ATSs, so things can be moved around in a very compliant way.
Why don't we skip over to Robbie next? Robbie, how steep is the learning curve for clients who show interest in digital assets, and what is the most difficult thing for them to get their heads around?
Well, I think it can be quite steep, particularly if we're talking about large institutional allocators. And in terms of things that are difficult to wrap their heads around, I would say today it's far and away the portfolio construction dynamic and how to think about risk and how this interacts with the rest of the portfolio. I think a lot of that has actually been compounded by an own goal that the crypto industry has scored, which is leaning into this narrative around Bitcoin plus the rest of crypto being a so-called risk asset or risk-on asset, which in many ways is kind of an intellectually vapid framework to begin with. But then when you add the fact that it's probably wrong, at least for Bitcoin, I think we would prefer to think about it as interest rate sensitive assets, right? Bitcoin is absolutely an interest rate sensitive asset. It's massively short real interest rates, as are many other assets that one would hold in the portfolio. But when you look at it fundamentally, and particularly over a longer time horizon, putting aside short-term trading noise and the fundamentals of this as a global, scarce, non-sovereign, decentralized asset that is insulated in many ways from some of the country and geopolitical risks that exist, well, that starts to look very different in a portfolio, right? And so many of our clients are grappling with this dynamic where they see some short-term trading effects that make it look one way, and they understand the long-term investment fundamentals they think that would suggest a very different approach to what it can do in a portfolio from a diversification perspective. And so we're on that journey with them. That's a lot of education, in many cases over multiple months, but it's a very important one.
Well, Zoe, let's go to you next. I mean, we were, I think digital assets do have some non-correlated returns in a portfolio. And from your perspective, what is the appropriate level of allocation that institutional investors should consider when they're looking at bringing digital assets into a portfolio?
So what I'd like to say is zero allocation to the space is the wrong answer. More than 2 to 10%, 10% if you can't stand it, if you're not all in on the space, is also the wrong answer. This is a nascent asset class. It is risky. But what has us all excited about the space, it's the asymmetry of risk-reward. So as long as the risk is mark-to-market loss, permanent loss you don't come back from. So FTX, if you had all your money on that exchange, you lost it. Although actually a parenthesis, in my decades in the market, I have never seen a company coming out actually of Chapter 7, liquidation, not Chapter 11, where if you had a claim against that company, you got 148% of your money. That's unprecedented, by the way. So it's the asymmetry, and the reason you got that money is on that balance sheet, this brilliant young man, it's a tragedy that he'll be in jail for many, many years to come. He didn't have adults in the room, but he had Solana, which was up 1,300% last year. So it's the asymmetry of risk-reward. You invest in the space, don't invest so much where you get fired if there's a drawdown of 50%, but you invest enough to actually have a diversified exposure, and I'll come back to diversification in a minute, where the asymmetry of risk-reward is if you give it to the adults in the room who are good stewards of your money with institutional products that make sense, you can make 100x, 1,000x. I haven't seen the symmetry of risk-reward like that. You can lose 50% of your money in many of those traditional investments without 1,000x. So I think that's the basic selling point. It's very interesting looking at this panel. I was actually with Brian Armstrong at the Wall Street Live conference many, many years ago. And, I talked about the right allocation is not zero. Since then, there's been a lot of vicissitudes, if you will. But it is a diversifying asset. By the way, correlations are very unstable things. So I agree with the point that maybe right now it trades as a risk-on asset. But if you look at the last 10 years, what happens to the volumes of Solana are very, very irrelevant to what the monetary policy is of Japan. So it is a non-correlated asset. And as we know in the institutional asset allocation space, diversifying your risk with enormous upside, that's a pretty good free lunch, as they say.
Lauren, let's go over to you and talk a little bit more about the ETFs. We obviously earlier this year had the long anticipated and awaited approval of a spot Bitcoin ETF. How has this been impacting institutional engagement with digital assets, both maybe domestically and internationally?
Yeah, so obviously a watershed moment to finally receive approval in the US for the spot Bitcoin ETFs. And I think this is well understood to be, an incredibly important next step towards accessibility for investors. But perhaps, maybe the underappreciated point is that in many ways it is a next step towards utility. As investors are able to put this into their portfolio, as potentially in these different geographies globally, these vehicles become more diversified, become more accessible. That leads individuals, retail investors, and institutional investors globally to be able to engage with this asset class in a way that they haven't before. And that sparks the conversation about what the utility of digital assets can really be. So obviously an important step in the US, but we also see globally a really, really important evolutions, whether it's in Canada, a more mature market, a ETH staking ETF, whether it's the next wave of ETFs going up for approval in Australia or recent approvals in Hong Kong. We continue to see global jurisdictions paying close attention and seeing and grappling with how to move forward with these vehicles. And I think that's an incredibly important development for the space.
Yeah, well, and I think we should have a probably punted decision on the ETF soon. But I think that inevitably that is something that we will have here in the US. It's just probably a matter of time. Why don't we switch for a second to tokenization? And I think this is a really important topic because I think this was a very big deal back in 2018. The idea kind of went away and now it seems to be emerging again. But Robbie, maybe can you first kind of talk about like what you think about when you hear the word tokenization and what that means, and then also kind of discuss the shift in the financial system to being more open to tokenized markets and products.
Yeah, well, when we look at the digital asset space broadly, we put it into three pillars from a BlackRock perspective, which is crypto, stablecoins, and tokenization. We think all three of those are important. And when you look at what we've done, they kind of map across those three. Tokenization is the longest time horizon to real adoption of the three, for sure. And I think there's been some maybe overinflated expectations about how quickly or decisively this trend would play out. We're talking about a major transformation potentially of capital markets infrastructure that affects all types of entities across the value chain. That's not going to come easily or quickly, right? So we're starting to see some development that suggests that this is working, that there's client demand, that the utility of being able to hold a TradFi investment exposure in a digital asset wrapper is actually compelling to investors, certainly to some of our clients. But in hindsight, it was kind of always going to be the case, contrary to what some had thought, including myself originally, that before we would move trillions or tens of trillions in assets into this new technology paradigm, that actually first institutions were going to get comfortable with small exposures to crypto itself, understanding wallets and blockchain-based settlement and being comfortable with the risk controls and the infrastructure supporting that. So that's kind of what's happening. You're seeing more institutions get into crypto a little bit, and that I think is helping to pave the way one day for a broad-based transformation in tokenization.
And you did mention stablecoins as well, because I think of stablecoins as like the original tokenized product, right? And it's tokenizing a dollar essentially. Are you seeing interest with stablecoins as a means of moving money around, or is that still a little immature?
Certainly. I mean, you could call stablecoins tokenized cash, right? We just think it's so important that we made it its own separate pillar. That's been by far the earliest adopted use case of tokenization. You see about $150 billion in stablecoins today, despite the fact that most pay no interest in a reasonably high rate environment, right? And that I think is a very important signal of just how much utility investors, users, etc. around the world are seeing in being able to have a dollar in a digital asset format that is global, that can be transferred in near real time at near zero cost.
Lauren, let's go to you next. I know that Coinbase has been looking at tokenization for a long time. what are you seeing as kind of some of the challenges for institutional investors into getting into tokenized products? And I know there are some regulatory hurdles potentially as well, but would love to hear your thoughts.
Yeah, well, I'll dovetail first, Robbie, on your comments regarding stablecoins, because I do think that that is such a critical gateway and such a critical sort of next step for institutions. You know, the fact that you can often now transfer a stablecoin like USDC in under a second for under a cent anywhere in the world with no delays, with no intermediaries, that is an incredible development. And it's in many ways only the beginning. I think it's sometimes underestimated just how meaningful that is for corporates, for entrepreneurs, for developers in terms of creating a new design space. And we certainly have seen much more engagement as we see the ease and transferability and cost come down for corporates to say, how can we integrate this into our existing systems? How can we really scale up our usage of these this asset? And so I think that's a really important sort of note as we think about what's the pathway to adoption on a broader array of tokenized assets. I think there are some notable barriers though. We need to see improvements in wallet technology. We need to see a greater ease of use and integration into existing systems. And as the space continues to march forward on that, I think that will have really important repercussions for and impact on the adoptability. In terms of tokenizing other assets, this is an area where I think, John, as you highlighted, there's some really important institutional investor engagement. And while it will be a gradual process, continuing to make crypto rails easier to build on and bringing institutions into engagement with crypto rails is what's going to spur that sort of creativity and recognition of new product adoption in this space.
John, let's go to you next. So we have the Avalanche blockchain. Ava Labs helps people build applications on top of that. Can you talk about how you're fostering traditional partnerships and getting folks used to operating on sort of public open source blockchains?
Yeah, what's really exciting about this cycle right now is that not only are real world assets actually being tokenized, as we talked about stablecoins and money market funds and all the other things that is happening. So the product side and the demand for the technology is there. What's even more exciting is the quality of the partners Ava Labs is working with. Not only people on this panel, but also, as I talked about, world-class banks as well as world-class publicly traded asset management firms. But I think there's also, I know this is a financial services conference and we're talking about real-world assets and the tokenization of value. But what's also happening is what I call also RWA, real-world activity being tokenized. And we're talking about loyalty points, and we're talking about in-game assets that trade for gaming companies. These are AAA publishers that have raised hundreds of millions of dollars to have a great game. So the use cases are expanding far more from a tokenization perspective, not just in financial assets and value, but also day-to-day activity in your lives. And that's where not only value will come onto the chain, but also users and the next billion users.
Let's turn now to the topic of regulation and compliance. I deal a lot with regulatory issues at the Blockchain Association, so a topic near and dear to my heart. But Zoe, how do we push forward principles-based regulatory frameworks so that our industry can continue to grow? I know a lot of work has been done on this, but there's still some work to go. So I'd love to hear your thoughts on regulation.
So it is the most important topic, and I think neither the regulators nor our industry, frankly, have shined in having a conversation as opposed to talking at each other. We talk our own book, and they talk their own. And again, at the Wall Street Live conference, one of the things Brian Armstrong proved to be as brilliant as he was, because he created a centralized model, a very important part of infrastructure. And for me, this industry will continue to grow exponentially if we learn to talk, not just to the SEC. It will, when you think about at Morgan Stanley, when we grew regionally, it wasn't the SEC principles I wanted to learn. If I went to Japan, it's the FSA you need to listen to. because when I talk to regulators around the world, the principle they all thankfully have is Bitcoin to Bitcoin, knock your socks off. The fiat on and off ramps, I'm going to regulate you the way I regulate SocGen, if you're talking to a Frenchman. And so our industry has been very slow to accept that concept. We pontificate a lot about how we're going to change the world, and we are. It's already changing. But in my experience, there are three principles regulators around the world, no matter how user-friendly they are to this industry, they will never compromise. One is investor protection, market manipulation, and AML KYC. We can talk about we're going to change the world. They're never going. So if you accept that, which obviously Coinbase, that's why they're growing exponentially, you accept the fact that the revolution will happen with centralized finance and decentralized finance coexisting. It's a false choice of the young people say we're going to fight the man. The man isn't going anywhere. JP Morgan and the centralized entities are going to be there. So I think that for me, and that's what when I talk around the world to people in regulatory roles, I don't know the answer yet, but I'd love for our industry to have discussions with regulators that say, how do we actually enable a positive revolution? For me, we talked a lot about the Bitcoin, blockchain technology is foundational technology that obviously faster, cheaper, it's a wonderful thing. So if you're a multi-billion-dollar company, saving some money on blockchain technology is wonderful. But the fact that you and I can exchange value, whether you're in Kenya or in Mexico, without a bank account, that's a huge revolution. That's actually a client base that JP Morgan has zero interest to cover. They cannot cover. And so for me, understanding those concepts, the principles that make this an exciting industry, where I feel the young people, ignorance and arrogance together is a very dangerous thing. So young people that you talk to, they actually are very, very excited because they're going to change the world. They're arrogant enough to think they're going to change the world, which means they will. But I think my generation doesn't understand how big and transformational this is. And I think with time and success, we will learn the right principles that will help this revolution.
So I agree with a lot of that, but I think the thing that the younger generation and the crypto crowd hasn't been able to figure out is, I actually think intuitively, the older generation understands how big it can be, even though they can't verbalize it. Mm-hmm. They don't know exactly what that means, and so there's fear. And I actually think a big part of what we could be doing is explaining why crypto matters for the United States, why crypto matters for JP Morgan's customers. Why, we've gotten to this place where we're talking so far past each other that there's no conversation that can happen. And I think there's a middle ground, and I think the stablecoin legislation that's happening now is a great example of that. So the translation point you made is everything. It's how you talk to the regulators. It's what you sequence. It's not everything, including DeFi to start. It's sort of, many things, not one thing. 3 years ago, we were terrible at that. I do think this time around we're doing a bit better. Unfortunately, it's become more political. It's an election year. We need to make sure crypto is not a Republican-Democrat issue. We're heading in that direction this year to allow for that conversation to happen.
You're right, but again, for me, I'm unique because I kind of run a company that I knew implicitly I go to jail if I do the wrong thing, even if I say I'm going to change the world. So for me, ultimately, no matter who your audience is, whether it's a BlackRock investor or a regulator, the world is self-interested. What are you going to do for me? This vision thing is wonderful. So if I talk to enough regulators, the ones that really want to want to help this, it doesn't help. I hear you, because you're talking to the choir, as I say. But it doesn't help to say, you're going to stifle innovation. This country, I'm a Greek immigrant. There's nothing more innovative than this country, So for me, the stablecoin explosion, positive explosion, is a very, very big deal, a very positive deal. But do you know why I know you know, to the audience, why the Americans are allowing this to happen? Basically, because you can make dollars available all over the world, because the world trade still is done in dollars. So to kind of send dollars to an SME in Kenya and to have access to that, that you can use centralized banks to get it done. So I hear you, and look, young people get it, the younger regulators abroad. Frankly, the gerontocracy in this country is the problem. You can be an SEC guy if you're 40 or gal, you get it. You don't need to preach to them. Yeah. The 80-year-old, 70-year-old, not so good. So again, for me, I haven't just come back from the Middle East. Wow, they are creating a revolution. I don't need to convince them. They want to learn, they get it. But I think ultimately, that's why I'm so, as you can see, passionate about the space. The first question people ask me, why are you in this? The implication be, why are you involved in this? That's what we have to change. Not their minds. We have to change that. When I was at Morgan Stanley, you raised your hand, you could have the best minds in the world come into Morgan Stanley. I don't want to be quoted on this. They have zero interest to go to Morgan Stanley, or oscillating above zero. The best and brightest minds are coming to this space to change the world. So I don't think we need to do a lot of proselytizing. I think we need to kind of understand the world isn't going to change for us anytime soon.
Well, I do think we're making a lot of progress on some of the public policy related issues, because this is a fundamentally different technology, and there are a lot of things like AML KYC policy that is, I think, very clear. It's been very long established. But then there are these other issues out there, like having a federal stablecoin regulatory framework or a market structure bill that makes sense for digital assets. But wanted to turn real quickly, because I think it was Steve, but I know we were talking about it a little bit backstage. There were two very meaningful votes on the SAB 121 repeal legislation. And so for those of you who don't know, that the SEC issued some accounting guidance that essentially requires any banks to count any crypto assets that they are custodying as a liability on the balance sheet. But do you want to talk a little bit, Steve, about kind of the because there was bipartisan support for undoing that policy,
I mean, I think,
and what that would mean if it.
I mean, it's a huge difference that you have both House Democrats and Senate Democrats that are getting on board with something that was, in my view, overtly a political dynamic to begin with a year ago. And so that's not by accident. That's the benefit of this being an election year. When you have, there's a laundry list of Democrats from Hakeem Jeffries to Cory Booker to Maxine Waters to at least 4 or 5 others, Gavin Newsom, who don't hate crypto. And really what I think happened, a year and a half ago was there was a moment of opportunity, and a group of Democrats with the administration took their shot, and they took a really good shot. So what will be very interesting is to see the president's reaction function. I'm sure people on this panel have a view. I hope he doesn't veto the bill. He probably will. It's a party line situation. But the cracks that you're seeing on that side, I think, are very much tied to the progress that we've already made at a grassroots level in crypto. So at some point, the conversations with regulators and then the generational dynamic and the politics all come together. This is one of those moments. It's going to be very interesting to see how that splits or doesn't split the Democratic Party.
More importantly, I think if this goes through, the amount of, because the rule, the amount of reserves a bank or a financial institution is required to have for the volatility of this asset is incredible, prohibitive from them doing anything.
Yep.
So if this goes through, the amount of tokenization and the assets that can be put on chain is just going to explode. So it's important that this works.
Which is why it was put to begin with, by the SEC. It was a very effective tool to block a lot from happening on chain.
I think to me, it seems like if we are trying to give consumers more options for places to hold and store their crypto, as well as institutions, allowing banks to get in the game would be an important step. But Lauren, can you talk a little bit, not to put you on the spot here, but I have really admired the way that Coinbase as a company has engaged with the government, both you know, in the courts when it comes along, but also in Washington. And I know that's not your core responsibility, but can you talk a little bit to, you know, sort of how Coinbase has like ramped up its engagement and kind of what the priorities are there, particularly with, I think we have this market structure vote coming up on the Fit 21 Act on Wednesday or Thursday. Can you talk about the significance of that?
Yes, well, certainly I think we've talked quite a bit about the importance of regulatory clarity. And I think everybody up here and really the industry can agree with one strong voice that regulatory clarity here in the US is very important. And so a lot of, you know, the efforts have been around that. But we also see, you know, the importance of global regulatory clarity. You know, there's been incredible progress that's happened in jurisdictions around the globe. And I think we'd applaud that and look to that as an important framework and reminder. But, you know, certainly this is an important moment. And, you know, we can continue to look for progress and clarity.
All right. Two final questions for the panel. First one is, and we'll just go down the line starting with Zoe. And I think you hit on this before, but to kind of put a final point on it, what is the most compelling reason for an institution to get involved in digital assets today?
I would put it in the context of actually diversification of a portfolio and to have the right allocation if you're an asset allocator, an institutional asset allocator, you want to have basically an allocation to a space that matters. And we're all in heated agreement. It's not just AI. It is actually the digital asset revolution is very real. And so you want to have an allocation to a space that's going to have huge upside, but also it will inform you. And so for me, a diversifying asset is important, but it will inform you on all the other things in your portfolio that it might affect. And what I mean by that, so educating yourself by having an allocation that's not so big where you get fired if you have a downdraft, but it's big enough you pay attention, is any intermediary, any centralized intermediary is going to be disintermediated at some point down the road. My favorite example is Spotify. Spotify keeps 30 to 40% of the content provider's revenue. Now, you know, unless you are Taylor Swift, you're going to go there and be happy with a 30 to 40%. There's a token, there's an application right now, a project that says to artists, and again, that's ecumenical and why I'm excited in this space, that it will change the world. The fact that if you're a content provider and I'm a content buyer, we should agree, peer-to-peer agreement on what that exchange is. I'll charge you 1%, not 30 to 40%. It's going to be years before they get Taylor Swift on it. But think about the cumulative geometric progression. The more artists they get, the more artists they get. So if I know how to track that disintermediation process by traditional asset classes, then I know what things in my portfolio I want to be paying attention to.
Robbie, why should institutions get involved today?
Well, it's a new emerging asset class, multi-trillion-dollar market cap today, right? And a transformative technology with major potential implications. I think what we've seen to date is that, you know, while you had 20-ish%, depending on the data source, of American adults holding some exposure to Bitcoin or crypto, obviously it was a fraction of that for institutions. And a big driver of that was historically there were enormous frictions for institutions to be able to hold directly. And now I think that's why the ETFs have been such a game changer, because they've brought that to a level of parity where you have, for the first time, efficient, turnkey, low-cost exposure vehicles. And so we're starting to see the journey that institutions now go on as a result.
Lauren?
I think we've talked a lot on this panel about the transformational nature of this technology. And, when you think about the implications for fundamentally changing the cost structure of entire industries, when you think about the implications for changing, accessibility for entrepreneurs and individuals to the global economy, these are big, important concepts. And for institutions to really zero in on them, I think it does take having some direct exposure and having some direct interaction with crypto rails and with these assets. So it is a engage to learn as this industry really matures and moves forward. But I think incredibly important, given again the transformational nature of what we're talking about.
So I'm an operator, so I'll talk about the technology more than the asset class, and I can say that institutions should get involved because their competitors are talking and getting involved and building, on the Avalanche blockchain or other blockchains. So they're going to be behind when the regulation is clear if they don't have proof of concepts or understand the technology or have assets already tokenized. So they need to get involved now because others are already moving forward.
Yeah, I'll be brief, but I just think we've talked about the liquid side. I think crypto is always layering in. Even today, the use cases that we're talking about now are very different than 3 or 4 years ago. So there is a regularly recurring venture cycle that's always healthy to invest in. So if you're not comfortable with liquid, start off with some Rails-based investment on the venture side, pair that with Bitcoin and Ethereum, maybe buy a tokenized money market fund. You're 80% of the way there and you're way ahead of most others. It's not that complicated.
All right. Well, I think we might actually wrap it up there because I don't think I've got enough time to get through the whole panel again. But, I would say, listen, I think that this is obviously an interesting space. It is, I think, a huge opportunity. If digital assets were going to go away, that would have happened a couple of years ago, and we're not. We're all sitting up here today, and there's a lot of exciting developments going on. So I want to thank our panelists and appreciate the time you've all taken to join us here at SALT today.
Thank you.